we really be asking that question? We'll find out. We also put the spotlight on the small cap mutual fund space and FPI's inflows into India. India has pretty much been a darling of foreign portfolio investors this year. I have all the editors with me, barring one. There's Nimesh, Anuj, Nigel. Guys, big day for India. The Chandrayaan took off, and with that, the markets took off as well.
Absolutely. I think in a way it was poetic that, for last 3 or 4 days we were struggling at 19,500. 4 days, I think we had gone above 19,500 and we had slipped. And today the market decided that just like that Chandrayaan mission was successful, at least the launch was successful, let's have a launch pad for the Nifty as well. And you know what? Now the day of 19,000 we discussed that the move to 18,000 from 18 to 19 took 21 months. Perhaps 19 to 20 is going to take 21 days. We are at 19,500 and you know what? How many days it's taken us? 10 days. 10 days. So exactly halfway through that mark now, and it's taken 10 days. So I think 11 more days to go and 20,000 would be here.
So the run rate has been maintained. We'll have to see how that goes. And when we're getting into closing bell at around 2:30, we're wondering whether 19,500 will be crossed. At the final tick was close to 19,600. Yeah. Forget about 19,500. And the Nifty bank that wasn't performing, that came in, because the IT index was wacky out of the park. You just needed the other batsmen to come in there, score a little bit. And that's what took us up. So good close.
I think what really, stood out in terms of the performance this week was the IT sector, right? And when you saw TCS's numbers, which were lackluster, but the market just jumped into it with a 3% gain, that's when you knew that the market momentum was serious. So, Anuj, that brings us to the question. I mean, every time the market hits new highs, we ask that question, should there be consolidation? But why should there be, right? Momentum is good.
You know what, Sonia, you will not remember this. I think you were really young, 2003 to 7. This market really makes me feel about 2003 to 7. I was also very young, but I had started my career at that point, of course. So
but actually, I'm still quite young on that rally, 2003 to 7.
Yes, but we were also observing that market at that time. Got a lot of ESOPs, and at that time when T18 stock actually was doing quite well, made a lot of money out of that as well. Those were really the
heydays.
Those were the heydays. But you know what? It feels like that. And the Nifty has now covered 19,000, 20,000, half of that distance. It's taken, as I said, 10 days to move from 19,000 to 19,500. My sense is we are not just stopping at 20,000. This is a market which is sensing something else, the kind of FPI money that we are getting, the kind of domestic money that we are getting, and most importantly, the kind of earnings growth that we are going to go through now from here on. It's visible in the economic numbers. I think it will be visible in the micro numbers from here on. And Nifty IT, as you said, 4.7% for the week, out of which I think 3.5% came today itself in the Nifty IT. And the other big factor this week was the big decline in dollar. And I think the fact that we have broken 100 on the dollar index opens up a plethora of money coming into India. And I was reading Chris Wood's note, the Friday note that he writes about India versus China and how India has really outperformed China. And Samir was here and he was making the point that that's going to continue. So I think that's really the big risk on rally factor. I want to give some time to IT because, we're talking about this in the morning. And I recently interviewed Ridham Desai last month. And I asked him this question on IT. And one point which he made, which really stood with me, is, and it really gave me a line, is that the point of maximum uncertainty is also the point of maximum returns. And if you look at what's happened in IT, after last quarter's howler from Infosys, IT has actually given the highest returns. You go back and check, you're getting surprised by today's move. Go back and see the 3-month moves. Most of the IT stocks actually are at almost 52-week high now, especially in mid-cap IT, Coforge, LTTS, Persistent Systems, Tech Mahindra, HCL Tech, I think another 5-6% it will hit 52-week high. So I think what's happening here, there are 2-3 factors why you're seeing this kind of a rally. Market is betting on 2 factors. What are those 2 factors? Factor number 1 is that have you already seen the worst of the earnings last quarter? And secondly, interest rate pause by the US Fed. And I think that is a bigger factor in terms of the recent rally, because what it does is, you'll remember the post-COVID rally. A lot of this rally was because the work from home culture had picked up and a lot of companies had saved costs, but also because the IT valuations had ballooned. 17-18 times, which used to be the normal, became 30 times for IT companies. After that, we saw that big rate hike by Fed, and the valuations came crunching down. Infosys bottomed out at 17 times. Now, I'm not saying we'll go back to 30 times, but even if we have to go back to say 21, 22 times, which has been the recent average of last 5 years for IT companies, that itself means that this rally has legs to go, and I think that's what the street is trying to price in. Numbers are very bad, make no mistake about that, and the commentary also was not that great, but the companies didn't scale down the guidance. That was positive. But I think the market believes the worst is over and valuations will pick up from here.
Okay, and Nimesh, what are the dealing rooms talking about? That's important because I'm sure all the dealers are going home, going to have a great weekend with the markets doing well.
Oh, absolutely, Sonia. But Nifty is technically in an uncharted territory, and we've seen this. No point fighting against the trend. That's the big statement that a lot of investors do make. But I'll give you another reason why. The fact is that right now is the liquidity which is winning over the fundamentals. Yes. Fundamentally we can argue in many sectors and many stocks that stocks have rallied pretty hard, valuations look out of the whack, but the fact is there is liquidity, and that's the reason why we are seeing all-time highs technically on every day. So that's one bit. The other bit is a lot of investors had turned cautious in the last one month, or like in the last 6 weeks or so. And for a lot of investors now, the cash calls are actually hurting them. Markets are going up every day, so there is a bit of left out feeling now among larger investors as well. The fact that they took a very early call of going into cash, and markets are only going up and away. Also, for the last 2 weeks, I've been saying this, that as we move higher, the breadth is going to get narrower and narrower, and only few stocks and few sectors are going to lead this rally. So we saw HDFC Twins helping the bulls, we saw Reliance one day helping the bulls, and now the IT has joined the party. So again, maybe the portfolio are not looking good, are not rocking too much, but as we move further higher, it's going to get narrower and narrower. And do keep in mind that it's liquidity now which is actually driving this market. So no point arguing too much from a fundamental point of view. That's a broad statement.
Absolutely. As they say, liquidity really is the mother's milk for a bull market, and that's what's happening right now. Joining us on the show today is Pankaj Tibrewal, fund manager equity at Kotak Mutual Fund, someone who's known to really pick mid caps and small caps. And Pankaj, as they say, right now, paancho ungli ghee mein for all the fund managers. Everything is doing well. I'm sure your funds would be doing extremely well as well. And you must be getting a lot of money. Are you now worried where to put this incremental money to work, or because it's tough to take a cash call when the market is going up like this?
Hello, Nikunj bhai, Anuj bhai, and hello all of you. I think we are a little cautious now at these levels, and there are many indicators which are suggesting that the market is in a overbought zone, especially in the mid and small cap segment. And let me share with you a few indicators which will probably help us understand it better. The first one, if you look at the total market capitalization of mid and small cap as a percentage of total market cap, it's now at about 28%. The last time which we saw was about 2008-9. And by total market cap, I mean the NSE 500 universe. And the large cap as a percentage has come down from 78 to 72%. So clearly mid and small cap as a cohort is at extreme highs. The second one which we track is the Nifty 100 value participation. And Anuj bhai, it's a very, very strong indicator which has helped us the turning points in the market. Today, when I look at that indicator, it's at a greed zone of 48. And history suggests that whenever anybody invests at these levels, the next 12 to 18 months returns tends to be inferior. The third point is more on the fundamental side. Today, when I look at earnings yield, which is nothing but 1 by PE, the earnings yield of large cap, mid cap, small cap is virtually the same. Hardly 30 to 40 basis points of difference of earnings yield between mid and large, which suggests that for any investor, why should anybody take additional risk in mid and small cap when large caps are available at the same valuation? And last but not the least, when I look at from March 22 to March 23, the free float in mid and small caps have gone up by 1 to 2% only. But whereas the shareholding, in a way, it's a proxy to the AUM growth, has gone up by 15% in mid cap and about 11 to 12% in small cap. So a large company chasing limited free float stocks is also what is fueling this rally. So need to be a little careful. And Sonia, I remember Peter Lynch quote that the biggest risk in bull market is forgetting that the markets can go down also.
Yeah, that's important. That's very important. I take that point entirely. It's very interesting that you made this comparison saying that, perhaps it's better to stick to large caps out after the outperformance we've seen in the mid caps, because Nigel has put together some very interesting data for us as well. Nigel, the broader markets have been outperforming, but now the narrative is that perhaps some consolidation on the cards?
Well, Sonia, at times when the music is good, the party is rocking, the drinks are flowing, it's always good, right? You need to keep partying because that's the way the party is going. But maybe sometimes you pause for breath, and then you resume the party, resume dancing, or maybe stand a little bit closer to the exit. May not be such a bad thing. So let's get to the point then. Will the, some bit of consolidation in the broader markets be healthy actually? And just a few points that I want to put up. There are around 4 points that I'm going to highlight. One is, you had a CLSA note that came in there. They said that the investor sentiment, well, it's entering into the bullish zone. So maybe extremely bullish zone. So that's point number one. The second factor is, the valuations. If you're looking at the mid-cap and the Nifty valuations, well, you just compare the two. The mid-cap PE is normally at a premium of close to around 15% approximately, mid-teens in comparison to the Nifty. Now you have the mid-caps that have outperformed. So that valuation gap, as it is, the Nifty is trading 5% higher than its 10-year average, and the mid-cap PE is at a premium of close to around 20% in comparison to the Nifty PE. So that's about the valuation front. Next, moving to the earnings yield that Pankaj just spoke about, well, you have the large, mid, small, and micro cap. Now, the yields out there, well, they have narrowed quite a bit because of the rally we have seen. When the stock prices move up, the yield has come down. Remember, a few years ago, we had the micro cap, the small cap yields, maybe they were in double digits as well. But because the kind of run that we have seen, well, that's narrowed down a little bit. So let's compare the yield spread to the large cap. That is nothing but the yield that you're getting on the mid in comparison to the large cap names. And that's, narrowed down considerably. In fact, you just compare what it is at currently and what's the 10-year average. You'll see that it's trading a little bit lower than that. So the yield spread to large cap, well, that's come down considerably as well. And finally, the mid and the small cap contribution to the total market capitalization, the point that Pankaj yet again made. In 2008, we had seen these sort of levels when it constituted close to around 29%. And from there, we saw a bit of a pullback. In December 2017 as well, it reached at 27-28% odd. As we speak, it's at around 28% odd. So some word of caution, maybe some bit of consolidation from the broader markets may not be such a bad idea. Pankaj, you want to come in on this? You made a couple of these points as well. But, some bit of a cool off that would be advisable, right, at these levels before we resume their up move.
Absolutely, Nigel. I think all these indicators, fundamental, technical, all are pointing out that a large part of the rally is done with, and it will be healthy for the markets if we consolidate with some price correction. However, as you guys were discussing, liquidity has been extremely strong. Earlier, domestics were pouring in money, but in the last 4 months, FPIs have joined the party. And together, domestic plus FPIs, I think liquidity flush is very, very strong. And that's what lifting the stock prices. But let's not forget that earnings growth this year will be around 12 to 13% for the Nifty, maybe slightly higher for the broader market. And the second point, which is very important to understand, is that this year will be a low growth revenue year for most of the corporate India, because last 3 years we have got a benefit out of inflation. Now WPI is in negative territory. So revenue growth probably will be much lower than what the street is estimating. However, margins probably will be much better as commodities have cooled off. So let's see how it kinds of weighs as you move ahead. IT sector is a classic case. You saw that the shorts were very, very high in the market. And despite of poor results, I think market is saying that the worst is behind us and taking it with a stride. So I think liquidity, I think, is winning over fundamentals. And this is the time to be really careful, because most of the mistakes are done in a momentum market like this.
All right.
So I would urge some words of caution out here, and would urge all the investors to carefully look into and introspect before investing.
All right, Pankaj, valid points out there, but sometimes you can't stop liquidity, right? And the way liquidity is clearly driving sentiment, driving the stocks higher as well. Nimesh, Shah put together a piece out there.
Yes, Nigel.
Liquidity is outweighing any of these valuations, fundamentals, etc., right?
Oh, true. And I said this as well, right? That liquidity right now is winning over fundamentals. Let me put this into numbers as well. The small cap fund in the small cap universe, the small cap funds in India, they saw record inflows in the month of June. In the month of June, month on month, the inflows was close to 5,470 crores. So, nearly $1 billion is what they're getting in a month, in that 1 month. In fact, for the last 3 months, there has been a record amount of inflows into the small cap funds. Now, when we talk about small cap funds, for the mutual funds as well, we feel like, okay, it's a small cap fund, small size, whatever. Guess what? The small cap funds are not small anymore. The Nippon Small Cap Fund, can you just guess what's the AUM they're sitting on? 32,000 crores. Wow. Can you imagine? So that's the kind of liquidity which is there in the hands of that fund manager is managing the small cap Nippon Small Cap Fund. Similarly, HDFC Small Cap Fund that has a size of close to 19,000 crores. I've just picked the 3 top funds, and the third fund in the small cap category is SBI Small Cap Mutual Fund. That's sitting on a AUM of close to 18,600 crores. Now coming to the mid cap category, even in the mid cap category, you'll be surprised with the highest amount of AUM, which is with HDFC Mutual Fund. They are sitting on an AUM of close to 43,000 crores, and that's the amount of money that looking to invest. In fact, Pankaj's one fund, which is Kotak Emerging Market Fund, he's sitting on an AUM of close to 30,000 crores. So that's the kind of AUM which he's also sitting on. Axis Mutual Fund is having a AUM of close to 21,000 crores, and Nippon India Growth Mid Cap Fund is sitting on an AUM of close to 16,000 crores. So, as even Pankaj pointed out, there is a lot of liquidity which is coming into the mutual fund schemes. In fact, we saw the reports as well, right? Nippon India has closed the inflows, lump sum inflows.
Yeah.
So is with Tata Mutual Fund as well. So that's that. I just wanted to put that number into perspective. That there is so much of liquidity which these fund managers are sitting on. Pankaj, coming to your fund per se, your emerging market fund has been a big outperforming fund, sitting on 30,000 crores of AUM. How are you finding it? Are you finding it very easy to deploy money at these levels?
Absolutely, Nimesh bhai. I think there are very little or small pockets of opportunity right now. And, when I look at the entire breadth of the market, I think there are few sectors probably where, from a 2-3 year perspective, things are looking okay. Our approach is that, at this point of time, don't get carried away by momentum. And every time we buying a stock, we are asking ourselves, how much is the downside? Forget about the upside. How much money I can lose in this stock? And if the stock goes down by 20-25%, whether we have the courage and ability to double it up. If not, then probably we are leaving the stock on the side. And I think there are a couple of sectors which probably are starting to look good and probably offer value at this market conditions. One is pharma, which I've been talking about for last few months. I think incrementally the things which are changing in US is positive for most pharma companies. And we believe that incrementally pharma is one place where you can hide yourself. Second is that we were evaluating IT, though, in the last 4-5 days, IT has seen a run up. But we believe that there could be pockets of opportunity in IT sector after the first quarter and towards the second quarter numbers. Also, the third important space is financials. I think financials, the valuations are not out of whack still, and the earnings growth will be strong even for FY24. Not as strong as we saw in FY23, but still compared to the rest of the market, earnings growth will be strong. And last but not the least, we think staples is one sector, consumer staples, which can do well in the second half of this year. So this is how we are in the portfolio, but very, very careful in making sure that we make less mistakes during this momentum market.
All right. Well, let's take a quick break on that note. The overarching theme has been that India has seen the largest amount of flows in the Asia-Pacific region this year so far from foreign portfolio investors. So we'll try and decode that data for you on the other side. Stay tuned. Welcome back. You're still watching the Editors Roundtable on CNBC-TV18. Now we are going to talk about how the FPI flows into India have been substantial in the year so far, and not only standalone, but if you compare it to a lot of our Asian peers as well. India this year has got almost $13 billion worth of FPI inflows up until now, since January of this year, and this compares to about much less for some of its peers like Taiwan, and there's been outflows for markets like Philippines as well. For India particularly, it's the biggest buying that we've seen since December of 2020, and we don't have the data for China, but the other markets show us that India has got a disproportionate amount. So let's get it on board. India has seen almost 13 billion, like I said. This compares to markets like South Korea and Taiwan getting just about $9 to $9.5 billion worth of money. If you look at some of the other markets like Philippines, there's actually been an outflow of funds this year, to the tune of almost about $430 million, while for Thailand, the outflow has been about $3.5 billion. Now, as we know, the macro situation for India has definitely improved, and that could be one of the reasons why FPIs are putting in money thick and fast. Remember, rating agency Fitch recently raised their GDP forecast as well. GST collections have been very strong. The sentiment indicators like auto sales, cement sales have also picked up. But another important reason why India has been gaining is because despite the rally, the valuations are not looking that expensive. The market valuations are in line with historical averages at around 19 to 20 times. To be precise, the numbers Nifty 1 year forward trading at 18.75 times versus the 10-year average of 17.5 times. So still not that expensive. But there are some risks that we have to put on the table. The investor sentiment now is in an extremely bullish zone. So CLSA put out a note this week where they said that the India Bull Bear Index has jumped to 92% bullish after the 15% rally that the Nifty has seen in the last 4 months. So Pankaj, my question to you is this on the valuation parameter, right? As you saw that graph on the channel, the valuations are still not as expensive if you compare to the 10-year average. Would you concur with that? And how much of an upside do you see for the Indian markets compared to global peers for the rest of the calendar year?
Yes, Sonia. I mean, that's what the point we have been talking about, that if one needs to be in the market, they need to be there in large caps right now. The broader markets have started to look expensive, especially the mid and small cap. And on large caps, if you look at the headline valuations, they are not as expensive. They are just one standard deviation higher than the long-term averages. And also, when we look at from a bottom-up perspective, there are many sectors, probably, and stocks, which are decent weights in Nifty, which have the probability of moving higher from the current levels. So from a broader market perspective, we are a little careful. But from a Nifty perspective, valuation, as you're rightly pointing out, it's not as high as one would expect it to be. So more cautious on mid and small caps right now as we speak.
Sure. Pankaj, before I let you go, within the auto space, is there a case to be bullish on the battery businesses? I know you won't talk stocks, but broadly, you think there is still a lot of room for outperformance in the auto ancillaries, within that the battery businesses? Your view.
So Nimesh, if you look at battery business in India is between 2-3 players, and our belief is that IC engine is not going away in a hurry, and at least for next 7-8 years, IC engine in India is going to stay, and along with it, I think the EV ecosystem will start developing. I don't know if you are aware, now there are at least 50,000 manufacturers in China who are associated with the entire EV battery system. Somebody is manufacturing cathode, somebody is manufacturing something else. And that entire space is now occupied by China. China now commands 80% of the value chain of the entire world in EV batteries now. So incrementally, if world was to adopt EV, I think they have to rely on China. And with the geopolitics which is going on, I am not very sure that how US will rely on China for the entire supply chain of EV batteries. So I think, in India also, there are a couple of companies which have taken the lead. And our sense is that they are executing well at the ground level. But it's too early to take that call on the EV battery in India.
Sure.
But from a growth perspective, we think that batteries have a long runway for growth even at these levels.
Right.
Okay, a long runway for growth. We'll end on that very optimistic note. Pankaj, thanks a lot for joining us. And to all you viewers, have a great weekend. We'll see you again on Monday.